So today we're going to talk through the financial statement conversion, picking up where we left off. And start here. This is a very important slide this semester because it represents a graphical representation of the Modigliani-Miller model. And that is the model that we're going to use to do our cash flow valuations. Right? So the idea is that a company is worth the sum of its future cash flows discounted to a present value. So what we are going to do is we're going to take the cash flows and we're going to divide them into what we call operating cash flows and non-operating cash flows. Right? So operating cash flows are the cash flows primarily derived by selling products and services to your customer. So the idea is if we have more volume of activity, we'll have more operating cash flow. If we have less volume of activity, we'll have less operating cash flow. So operating cash flows are primarily coming from sales. But companies also have some other assets which can provide them value. And we will call these non-operating cash flows. Right? So they have nothing to do with the sales of the customer. They just happen to be cash flows, or they happen to be things that the company owns. So two common forms of non-operating cash flows. Number one, excess cash. So if a company has a lot of cash sitting around in the bank, earning 1% interest, 2% interest, that adds value to the company, but has nothing to do with getting more sales from customers. Right? So we'll treat it as a value, we'll treat it as a non-operating cash flow, and we'll add it to the value, but we'll separate it out from the operating cash flows. Another example would be, let's say a company has a minority stake in another business. Right? So I own a piece of another business that I don't control, I don't run, I just own a piece of it. Well, again, I might get some income from owning that business, but it's a non-operating cash flow. I don't run that business. It's not part of my day-to-day operations. So again, has value, put that into my valuation, but I'll treat that as a non-operating cash flow. So the key is we're going to take the operating cash flows, the non-operating cash flows, and add them together, and that's going to get us something called enterprise value, or EV. And then if we subtract the debt value, okay, because the enterprise value is all the cash that's going to be available to the debt and the equity holders. If we subtract all of the debt and debt equivalents, so anything that's interest bearing that requires a return is going to be considered debt. So for example, bank debt, commercial paper, bonds, we mentioned the concept of leases, unfunded employee obligations, things that have to be paid back that require a return are going to be called debt or debt equivalents. All right, so we're going to subtract those from the enterprise value, and whatever's left belongs to the shareholders, because shareholders get the residual value, residual cash flows of a business. And then that's going to be called the equity value. Right? Divide by shares equals share price. That's the method we're going to use for enterprise DCF. All right, but the key is, and we're going to use a mnemonic this semester to help us understand the cash flows that are coming from each one of these, what I'll start calling boxes. Right? So this is a mnemonic solely used in this class. If you go anywhere else in the rest of the world and you start using these mnemonics, they'll look at you like you're nuts. Right? So this is just something I've developed to try and help you understand the process more quickly. So the mnemonic is that we are going to call operating cash flows box 1 cash flows. Okay? So we're going to label it a 1. And the mnemonic is for box 2, non-operating cash flows are going to be called 2s. Debt cash flows are going to be called 3s, and equity cash flows are going to be called 4s. So 1 plus 2 is enterprise value, 3 plus 4 is enterprise value. As a matter of fact, equity value, 1 plus 2 minus 3 equals 4. All right, if you want to rearrange the cash flow boxes. But this is going to be important because what we're about to do is we're going to take financial statements and we're going to rearrange them and map the financial statements to this Modigliani-Miller model. Right? That's going to be what we're going to call the economic statement conversion. So it really involves a process where we have to label each of the statement items, 1, 2, 3, or 4, so that we can properly map it to the appropriate Modigliani-Miller box, and then we're going to rearrange the cash flows or rearrange the statements into these boxes, right? That's really the process that we're about to go through. Okay? So with that in mind, a couple of terms that we'll define, but I think it'll be helpful if we use this graphic to understand what we are about to do. Okay? And so the idea is that we're about to move from GAAP accounting statements to what we're going to call economic statements, and it's these economic statements that will drive the cash flow value of the firm. Okay? So that's really the overall process that we're about to do. So we'll start with the income statement and the balance sheet, do the GAAP accounting statements. And I'll just start with the balance sheet arbitrarily. It doesn't really matter which of these two statements you start with first. You can do either one. But what we're going to do is we're going to take the balance sheet and we're going to label everything. We're going to label it as operating, 1, non-operating, 2, debt equivalent, which means it has a interest item attached to it, 3, and then equity equivalent cash flow, 4, right? And then it's just going to be like if you ever played with Legos when you were a kid, you're going to take this little Lego thing, you're going to rip it apart. There's going to be Legos everywhere. And then what we're going to do is we're going to put it back together. And we put it back together, the important thing, no Legos left on the floor, right? Because these statements, balance sheet, for example, has to balance when we rearrange it, right, in a new format, just like it balanced before we started when the accountants gave it to us, right? Because we have to account for every single item that's on the financial statements. And again, we're just going to reorganize it and remap it to the Modigliani-Miller model. So anything on a balance sheet that is operating, or something which we will label 1, we're going to put together, we're going to net, you still net the assets against the liabilities, and the netted ones are going to be called invested capital. Right? So specifically, we're going to call that the operating invested capital, but we'll call it invested capital for short, but that's the idea of invested capital. Invested capital is the cash tied up in the balance sheet that we're going to use to support the operations of the business. That's invested capital. And then what we're going to do is we're going to net the 2s. We're going to net all the non-operating assets against all the non-operating liabilities. Okay? And then we're going to take that netted non-operating number, we're going to add that to the invested capital, and that's going to get us something called TFI, total funds available to investors, also known as total funds invested. Okay? So that's the amount of total cash that we have tied up in operating and non-operating activities. Right? Well, that total funds invested is going to be financed by the debt equivalents, anything that's interest bearing, and the equity equivalents, all the equity that's tied up in the business. Again, 1 + 2 = 3 and 4. Right? We're going to do the same thing with the income statement. We're going to go through every income statement item. We're going to label it 1, 2, 3, 4, operating, non-operating, debt, and equity, and we're going to reorganize the income statement. Right? So all of the operating items on the income statement are going to get us something called NOPLAT or NOPAT, and we'll use those terms interchangeably. Right? NOPLAT is a McKinsey term. NOPAT is the term the rest of the world uses. NOPAT, net operating profit after tax. NOPLAT, net operating profit less adjusted taxes. Right? So again, means the same thing, just McKinsey calls it NOPLAT. Right? So the operating cash flows from the income statement, NOPLAT. The non-operating cash flows from the income statement, we'll then put those up together. We'll then take the operating cash flows, the NOPLAT, the non-operating cash flows, add them together, and that's going to be something which we're going to call TII, total income available to investors. Right? The TII is then going to equal to all of the debt equivalent items from the income statement, interest expense, all the equity equivalent items off the income statement, net income. Debt plus equity also equals TII. So essentially, we're just going to remap and rearrange the income statement to match the Modigliani-Miller model. So as I said, it doesn't matter which of these statements you rearrange first. You can rearrange the income statement first. You can rearrange the balance sheet first. Right? However, what does matter is that to get to statement number 3, we have to have already done the income statement and the balance sheet. Because the third statement is going to be the statement of what's called CFI, cash flow available to investors. Right? And in order to generate that third statement, we need to have the income statement and the balance sheet rearranged. Right? So the third statement comes from the first two. Right? So the third statement is, again, the cash flow, CFI, cash flow available to investors. Right? Now, here's the key to CFI. The CFI statement is really looking at the operating cash flows, which are called free cash flows, plus the non-operating cash flows. We're going to add those together, and that's going to be called cash flow available to investors, CFI. And that's the cash flow that equals what we'll also call the financing flows or the fund flows of the business. The cash flow available to the debt holders and the cash flow available to the equity holders. Right? So again, we're going to map the cash flow statement, the rearranged one, so it's not the GAAP cash flow statement. It's going to be the economic cash flow statement of CFI. Now, in order to do the 4 sections of cash flow, free cash flow, non-operating cash flow, debt, and equity cash flows, what we're actually going to do is cash flow is cash from the income statement minus the change in the balance sheet. All right, just conceptually, that's the idea of cash flow. So it's the cash you generate in the income statement minus any investment made in the balance sheet. That's cash flow. So we're going to take that process 4 times. So what is free cash flow? Cash from the income statement, no plat. What is the cash invested in the balance sheet? Change in invested capital. No plat minus change in invested capital equals free cash flow. What is non-operating cash flow? Non-operating cash for the income statement minus change in non-operating investments in the balance sheet equals non-operating cash flows. Add those 2 cash flows together, cash flow available to investors, CFI. Debt cash flows on the income statement, interest expense, minus change in debt on the balance sheet, cash flow to debt holders. Tricky part, the cash flow on the income statement is actually technically not a cash flow to the shareholder because we don't always pay out the net income. So one of the tricky parts we'll get into a little bit later is the cash flow from the income statement to the shareholders is actually the dividends paid minus the change in equity investments on the balance sheet. Okay? And that's going to get us the equity cash flows. So that's going to be the 1 period cash flow that a company generates or has a deficit of, if it's a negative number, is CFI. Then what we're going to do is we're going to forecast the CFIs into the future. So we're going to have CFI every year. We're going to have free cash flow every year. We're going to have non-operating cash flow every year. Right? When we sum them up, all those forecasted cash flows, all the forecasted free cash flows summed up and put in present value, operating cash flow of the firm, cash flow from operations. All of the non-operating cash flows forecasted and discounted back to a present value, the non-operating value of the firm. Operating plus non-operating value is enterprise value. Another way to look at enterprise value is if I forecast all my CFIs into the future and discount them, that's my enterprise value because I'm forecasting the operating cash flow value and the non-operating cash flow value. And that will equal the debt value. So again, if I forecast all of my individual cash flows to debt holders every year, I get the overall value to the debt holders. Same thing with the equity. Right? So again, what we're doing is we're really just going to follow the Modigliani-Miller process for valuation over here on the right-hand side. And we're going to start with the accounting statements, and we're just going to go through a process to rearrange the cash flows so they map to those 4 parts. And then we're going to forecast the 4 parts, and that's how we're going to value the firms. And that's also how we're going to do analysis. Right. Questions about that conceptually at this point? All right. So we're going to start arbitrarily with a balance sheet. I know I'm recording this on video, so I'm going to draw this on the whiteboard. See? I'm not going to draw on the whiteboard because there's no markers in this room. So if I were to draw it on the whiteboard, all right, note to self, bring markers to future classes. So I guess I'm going to draw it in a drawing program. I guess I'll draw it in PowerPoint. So here's the idea. If I look at my assets of a firm, let's see, and I want, let's make them blank. My assets in a traditional balance sheet are going to be broken out into current assets and long-term assets, or short-term assets and long-term assets. However, what we are going to do is we are going to break our assets into what we're going to call operating assets and, let's do a text box here. Where was the, oh. And non-operating assets. So this is the rearranging of the balance sheet that we're going to do. So instead of current assets and long-term assets, we're going to reshuffle the assets into operating assets, non-operating assets. Again, what's the idea? The idea is the operating assets support selling products to the customers. The non-operating assets are just other miscellaneous stuff that we own. Right? And we know that a balance sheet has got to balance. I'm going to copy this, clone my balance sheet assets, because that is going to equal to my liabilities and equity. Right? So what we're going to do is we're going to rearrange the liabilities. So instead of having current liabilities and long-term liabilities, we're actually going to rearrange the liabilities into 3 sections. So section 1 2 and 3, and I'll just show you there'll be a section 4 here. But section 1, liabilities rearranged, are going to be called put my text box over here, just move it in, are going to be called operating liabilities. Liabilities. These are my 1 liabilities. And then what we're going to do is we're going to have a second part of the liabilities, which we're going to call non-operating liabilities. Things that aren't related to our business. It's smaller so it fits in my box. Right? The third form of liability is going to be our debt. So this is any interest-bearing debt. So that's the point. We're going to rearrange the liabilities into these three categories: operating liabilities, non-operating liabilities, interest-bearing debt. And finally, we're going to have equity. That is our rearranged balance sheet. Right? Now, why do we do this? Well, here's primarily the reason. In a traditional world, this is called traditional invested capital. So if you learn invested capital in any other class besides this one, and if you learn invested capital by going to Bloomberg or CapIQ or one of the data services, and you look up invested capital, this is the definition that is commonly used. It's all of the debt and all of the equity of the firm. Right? Now, how is that different than the definition of invested capital that we're about to use? We're going to define invested capital as the operating items. So our invested capital is going to be these operating assets IC equals, actually I'll call this operating invested capital. Even though we'll call it invested capital, it's technically the operating invested capital equals the operating assets minus the operating liabilities. That's the definition McKinsey uses. That's the definition we're going to use in this class. How are they different? What's different about the operating invested capital versus what I would call the traditional definition of invested capital? And by the way, people will call invested capital capital employed. They'll call it net assets. There's a lot of names they'll use for it. But in this case, for invested capital, what's different? So we're basically saying invested capital is this minus that. As I said, if you think about it, I'll put my labels in here. These ones, these are going to be my ones. I just add the labels. My twos my twos, my text box twos, these will be my threes. It'd be much easier if I could have written on the whiteboard. And these will be my fours. So again, invested capital in the rest of the world is 3 plus 4. What's different? Yeah.
Well, for starters, you're like including
Well, we're looking at assets netting liabilities, but actually this does look at, the traditional definition does look at assets and equity netted. Assets, liabilities, and equity netted, because it's all assets minus all non-interest bearing liabilities equals interest bearing liabilities and debt. That's the traditional definition of invested capital. All right. So let me put it to you in a different way. Apple just reported their earnings 2 days ago, and they obviously disappointed investors because their stock price went down like $40 a share the day after they reported their earnings, because they just met expectations, and the investors were hoping they were going to beat expectations. The next couple quarters, they said, we're going to be non-big growth quarters. So anyways, stock tanked. But long story short, they reported they have now about $140 billion worth of cash, which is a lot of cash, right? And they have like 900 and something million shares outstanding, close to 900 million shares. But let's just, for the sake of argument, call it 1 billion shares, just to keep the math simple, right? So I'm gonna kind of distort their shares, say it's approximately 1 billion, but it's actually less than 1 billion because they've been buying back some stock. Let's just say they have about 1 billion shares, and they got $140 billion worth of cash. It's actually 142, but again, I'm gonna keep the math simple. So here's the way I want you to think about this. If they have about $140 billion of cash, and they have about 1 billion shares outstanding, then this is $140 a share. The non-operating assets, okay? If their share price is today around, where is it trading? Is it 506? So quick check. Yeah, 506 before pre-market. So what's 506 minus 140? Thank you. Can't do any math anymore. They have 366 of operating assets. They have 140 of non-operating assets, just to keep it simple, right? So here's the point. In order to sell more revenue, do they have to spend $506? What do they really have to spend? 366. That's the problem I have with the traditional definition of invested capital. Because the traditional invested capital says, I get a return on my debt and equity. And so therefore, my debt and equity equals all my investment in the business. The value of 506 for Apple. So that's the point. I want to return on all 506. And that's reasonable. I want to return on all my investment. However, if I think about the actual way that the Apple's going to work, is that Apple doesn't need to invest $506 billion to sell more stuff. They're only tying up $366 billion, the operating value. So really, if I keep the non-operating assets going up at the same rate as my operating assets, it's not a realistic view of the company, because they're not going to keep investing to grow sales. They don't need $140 billion worth of cash to sell the next 100-something billion dollars worth of revenue. That just doesn't make any sense. You don't have to keep adding more cash to sell more stuff, right? So that's the point. The problem with traditional invested capital is it assumes that the non-operating assets go up at the same rate as the operating assets. And so what we want to do in this class is we want to separate it out so that the non-operating assets go up at a different rate than the operating assets, right? And as simple as that sounds, it makes a big difference when you value a company. Because like I said, in the traditional view of Apple's return on investment, then what it means is that Apple is going to keep spending non-operating assets every time they grow, right? And they don't do that. Companies in general don't do that. So we want to have them go at separate rates. So let me go back to the other PowerPoint. So the idea is, I'm still in the same PowerPoint, so I added as a different slide. What we're going to calculate is return on invested capital. Our definition of return on invested capital is the NOPLAT, the operating profit, divided by the operating assets. But we're also going to calculate a return on the non-operating assets, because we're going to have a non-operating profit divided by the non-operating assets is a return on the non-operating investment, right? So we're going to have a return on both, right? So practical application. So last year, I was asked to speak at Molson Coors senior executive meeting in Fort Lauderdale. So it was about this time last year. And at that meeting, Molson Coors wanted me to basically say what a terrible job they had done running their business. Because factually, they're the worst performing beer company in the world financially, right? They're the only beer company over a 5-year period of time that had lost value. So if you were a Molson Coors shareholder, you lost money investing in Molson Coors. Every other beer and alcohol company made a ton of money. Molson Coors was the only one that you lost money in as a shareholder. And that's bad, right? Because basically we're in like a alcohol nirvana right now. You know, people are paying lots of money, alcohol is growing, prices are rising, and Molson Coors has none of that. Right? And part of that is because everybody else is into hard alcohol and spirits and other things, and Molson Coors is just cheap beer, real cheap bad beer, right? Because they make things like stuff that is people buy in college when they can't afford anything else, right? So, anyways, long story short. So here's the thing. What they wanted me to say to their senior leaders is their return on invested capital is really bad, right? So their return on invested capital, and this is the data that came out of Bloomberg. I don't have the number in front of me, but I think it was something like, let's just say it was something like 4 to 5% was their overall traditional return on invested capital, right? But here's the thing. Their cost of capital, which we're going to compare it to, their WACC was 9%. So do you want to borrow at 9 to make 4 to 5? That's why the share price was going down, right? Pretty simple. So basically the message was, stop doing that. Let's not grow. Let's not invest, right? But I upset them because when I got up in front of their group, I gave them a slightly different answer. I said, yes, you do have a negative spread. That is a true statement according to the financials that you're reporting and all the data services would pick up. You look it up in Bloomberg, they have a negative spread. However, when I rearrange your statements into operating and non-operating, your beer business, the operating return on invested capital, is 14%, approximately. I think it was somewhere in the, I forgot the exact number, but 12 to 14. It was in that range, right? And your non-operating ROIC is 2%. Because they have a big joint venture with Miller. And they have a horrible performing joint venture with Miller. It's half their investment. So that's the point. That the reason why Molson Coors, the company, is doing poorly is because they have this horrible joint venture. But their beer business itself, the beer business assets that they own, run, and manage, actually gets a double-digit rate of return on investment. So should they stop investing in the beer business? That's what I'm saying. If you're naive, the answer is yes. Because if you look at the overall return on Molson Coors, they have a negative spread, so growth is bad. Growth destroys value. So don't grow. But that's not the real message I was giving them. It caused some angst. But the message I was giving them is you got to be more discerning. Your non-operating investments are performing terribly. Your joint venture is just horrible. You spent way too much money in this joint venture for the returns that you're getting right now. And that's what's dragging down your business. But the returns on your business are actually pretty strong if you take that out. So you should actually be investing more in your beer business, not less, right? And I'm just telling you, that's the important difference that we will be talking about in this semester versus a simplistic way. Because what the rest of the world calls ROIC, we will call return on, essentially, TFI. What they're doing is they're taking NOPLAT, same NOPLAT, or NOPAT, except they're dividing it by what we would call TFI. And what we're going to do is we're going to say that's not the way to really understand the business, because what we want to do is take the NOPLAT and divide it by the invested capital, right? And the reason why they're doing it TFI is they're saying debt and equity is invested capital, but it's really not. It's total funds available to investors. Now again, I'm kind of mixing language because this is McKinsey's terminology, but this is why McKinsey comes in, looks really smart, gets the big bucks, because it makes sense. And it definitely explains the value of the business better to sophisticated institutions than the simplistic approach that is often used in the real world, right? Because again, what we want to do is understand the drivers of value, and the drivers of value are different at the operating level and the non-operating level. So that's why it's so important to go through the process that we're about to go through. Matter of fact, here's the opposite company, Yahoo. Yahoo has a worthless business. They're not making any money on their search business. They're not making any money on their acquisitions. They just buy companies and then let them die. And then they just shut them down later, right? I mean, just look at all the Yahoo companies that used to have great services that were then bought by Yahoo and then just left out to die. You know, bookmarking service. Matter of fact, what was the one? Yahoo used to really have a bookmarking service that was really good. Yahoo had Yahoo Briefcase, which they pretty much shut down. Now everybody's getting to the online cloud storage. You know, Yahoo was a decade ahead of everybody else in cloud storage. They shut that one down after spending $1 gazillion to buy that business from somebody else. They had Yahoo Wallet, which they shut down, and now everybody's getting into e-commerce. I mean, it's just like Yahoo's just bad. They just do not know how to run a business. But Jerry Yang has made one smart decision before he was fired. He invested in who? It's one company that actually invested it. It's paid off handsomely. Alibaba. The entire value of Yahoo is Alibaba, a business they don't own and run. They have a minority stake in. And that is really what Yahoo is worth. So that's the point. Yahoo's the opposite. Yahoo is all non-operating value. It's their ownership stake in Alibaba. And the investors can't wait until they sell it and then cash in, because then they're just going to see that Yahoo doesn't actually create any value in and of itself running its business. And that's the problem. That's why Yahoo doesn't really want to sell Alibaba. You know, they're being pressured by the investors to do it, because you take away Alibaba, there's nothing left. There's just a poorly run search engine with a bunch of acquisitions that have never paid off. Now, they got a really smart person in charge now, Marissa Mayer, who came from Google. She's doing her best to turn it around. But I'm just saying, at the end of the day, she's no Google. She's not Google anymore. She's at Yahoo, and Yahoo just does not have the same sort of great products that Google does, right? And so they're losing out competitively. It's sad when Yahoo's actual search engine is powered by Microsoft. Because you have to remember, you search on Yahoo, it's actually Bing. They don't even have their own search engine anymore. So, you know, that's the problem with Yahoo, is that they're all non-operating value. But that's the point. If you really understand Yahoo, that's what you would see in the valuation. It's the non-operating value of Alibaba that really represents almost all of their share price. Their operating assets are almost worthless. So, again, different story, but by putting in this format, it gets us better understanding and insight to companies. That's why we're doing what we're about to do. So, back to the conversions. So here's the process that we're going to do, and we're going to start out with a simple balance sheet. So the balance sheet on the left becomes the balance sheet on the right, the rearranged TFI, right? So again, just so we can see this, I'm going to do this in Excel so it'll be easier to see what's going on. So basically, we have a very simple Excel balance sheet. We have inventory. We have, was it PP&E? And then we have equity investments. And then that is going to equal to our total assets. And then we have accounts payable. We have debt. We have common stock. And we have retained earnings. All right. So inventory, 200, 225, 300, 350, 1525, 515 and 600. We have 125, 150, 225, 200, 50 and 50, and 115 and 200. And if I add up my liabilities and equity on my simple balance sheet, they should equal the assets. And this was what? Last year, current year. All right? So I'm just recreating it very simply. Now, on the homework assignment that you're going to have for next week, which I'll hand out later today, and for your midterm, I'm going to actually give you the Excel spreadsheet, so you don't have to retype everything. But nonetheless, this is your next homework assignment to do what we're about to do. We need to convert this into a statement of TFI. So here's the thing, a couple of things. First, process that is often skipped, but this is something that will make your lives easier. Label the statements. 1, 2, 3, and 4. Operating, non-operating, debt, equity. 1, 2, 3, 4. All right. By labeling the statements, it will help you, because then you'll know where to put it on the converted statements, and you'll make sure that the items are in the proper place. So, inventory. Let's talk about our labels here. Is inventory operating? 1. Non-operating? 2. 1. And the idea should be, do I need more of this to sell more products? Okay. So yes, I probably need more inventory to sell more products. Operating. Net property, plant, and equipment. Basically a factory. 1 or 2? 1. I need to produce my product somewhere. I probably need some property, plant, and equipment. Right? Equity investments. I own a minority stake in another business. Yahoo to Alibaba. 2. It has value, but I don't need that to sell more of my products. But I am getting value owning somebody else's business that I don't run. Non-operating. 2. Right? Accounts payable. Money I owe my vendors for inventory that I bought from them that I haven't paid them yet. Well, we got the 1 and the 2 covered. It's actually considered operating, right? Because I basically am not paying my suppliers for stuff that I'm going to use to actually make products that I sell. So it's operating. I'll keep having accounts payable. I'll keep having to pay my suppliers in 30 or 60 days to buy raw materials and other inventory that I'm going to sell. So it's considered operating, right? Interest-bearing debt, bank debt. 3. Anything that's interest-bearing debt is debt. It's 3. Common stock at par value. 4. It's equity. Retained earnings. 4. It's equity as well. Right? So again, very simple balance sheet. We've just labeled it really quickly. So here's what I'm going to do. Let me save this just in case Excel dies. So I'm going to call this our in-class. Is today the 29th, 29, January 29th. All right, so this is my financials. So what I'm going to recommend is that when you convert these, you create a new tab in Excel so that every statement that you reconvert has a new tab. So in this case, we're going to do the reconverted balance sheet. We're going to call it TFI. And one of the reasons why I'm going to recommend doing new tabs is because I can copy and paste over. So copy, paste, there's my years. And now what I want to do when I rearrange the balance sheet is I want to net all my 1s together. So I'm going to take everything as a 1, assets minus liabilities. I'm going to net them together. So what are my 1 assets? Inventory equals inventory equals property, plant, equipment equals accounts payable. Those are my ones. And I even see my labels that are my ones. Now, what is invested capital? Equals the assets minus the liabilities. That's my invested capital. All right. Now, what is TFI? I take to my invested capital, and I take anything that's a 2. In this case, my equity investments. That's the only 2 I have. If I have any 2 liabilities, I'd put them on there. I don't have any 2 liabilities and subtract them. And that gets me TFI, which equals my invested capital plus my equity investments. And what is that going to equal? Any 3s and 4s. Do I have any 3s? I have a 3. Do I have any 4s? I have 2 4s. Equals my 2 4s. When I sum up my 3s and 4s, they equal my 1s and 2s. Total funds invested. This is my rearranged statement. The other reason why I like the labeling process, notice what I have on the right. All my 1s are together, all my 2s are together, all my 3s are together, all my 4s are together. The reason why the labeling will help you is that when the statement doesn't balance, so let's say I had this. This is an error. So on your midterm, to get a correct answer, you must not only have the right number, you must have a balancing statement. The correct number, but an unbalanced statement, is an incorrect answer. Because how do I know that my TFI is 390 or 340? I don't know. I know it's one of those 2 numbers, and I got a 50-50 chance of being right, but I don't really know if it's right. So that's what I'm saying. If I have an unbalanced statement, I do not have a correct answer, because I don't know which of those 2 is correct. I'm only 50-50 that I'm correct. All right? Now here's why labeling will help us. If I am in this situation, and trust me, you will be in this situation in the midterm exam, because the statements will be far more complicated than this one. The midterm exam is in 2 weeks. So here's the idea. What I do is I can say, gee, do I have all my 1s accounted for? 3 1s? 1, 2, 3 1s. Yes. Do I have my 2s accounted for? I got 1, 2. Yes. I got 1, 3. 1, 3. I have 2 4s. Oh, there's only 1 4 here. Helps me figure out, that's the Lego that's on the floor. That's the one that I forgot. So the labeling process really helps you when you get into the situation when the statements don't balance. All right? So again, you don't have to do it. I'm just giving you the recommendation of the people that don't label are the ones that struggle in the midterm. And then I don't know how to help you at that point. All right? So again, I know it's a simple process, but it will help you. All right, questions about TFI? All right, nuance. This is a correct answer. If you submit this answer for your midterm, if you submit this answer for your next homework assignment, homework 2, which will be due next week, this is a correct answer. All right? But you'll notice that the answer in the book, which is on this PowerPoint slide, is slightly different. And what's going to be slightly different is McKinsey is setting us up for forecasting later. And when we forecast later, we will take the current assets minus the current liabilities and the long-term assets minus the long-term liabilities, because we'll forecast working capital at a separate rate than long-term assets. So what they do is they take the current assets minus the current liabilities, and they call that operating working capital equals inventory minus accounts payable. Then for invested capital equals operating working capital plus PP&E. Gets the same answer, but they do put in this notion of working capital. That's the answer that they actually have in the book. Now, this again is more important after we get the midterm. We start forecasting statements. We will forecast that operating working capital goes up at a different rate than property, plant, and equipment. Same idea as the operating and non-operating investments. If I invest in inventory, I'll invest in inventory at a different rate than I will have to build new facilities. So I want to be able to forecast that at a separate rate. I forecast my working capital differently than forecasting my PP&E. So they're setting it up by doing it this way. But technically, to get invested capital is just all the operating assets, long-term and short-term, minus all the operating liabilities, long-term and short-term. If you net those out, you'll get a correct invested capital. And so that's perfectly fine. But if you want to set it up this way, this is the way you'll see probably an answer key, because this is the way we're going to use it after the midterm. That's the rearranged income statement. Questions? All right? Sorry, rearranged balance sheet. Now we're going to do the income statement. And by the way, on this slide, this will give you common examples that are on real balance sheets that go into each category. And the book talks about that as well. All right, rearranging the income statement into TII. So here's what we're going to do. We're going to go back to the financials, and I'm going to write out the income statement categories. So they had revenue, operating costs, depreciation, operating profit, interest expense, non-operating income, earnings before tax, so call that earnings before tax, taxes, and net income. Now, just so I'm keeping my years straight, the income statement is in the current year. So, was it 1,000 minus 700 minus 20? Operating profit is the sum of those three. Interest expense is negative 20. Non-operating income is 4. Earnings before tax is sum of operating profit and those. It's 264. Taxes are negative 66. So net income is the sum of that, 198. By the way, my tax rate equals taxes divided by earnings before tax as a percentage. Taxes, flip the sign. Taxes are 25%. That's my tax rate, based on the date on the statement. So that's a simple income statement. So again, we want to, just as we labeled the balance sheet, operating, non-operating, debt, and equity, we want to rearrange and label that statement as well. So let's start out with revenue. Is revenue operating or non-operating? Operating. Comes from customers. Operating. Now, you could theoretically have some non-operating revenue, but prior to the midterm, I'm not going to trick you that way. Okay? We'll have to deal with that with some companies. They might have some operating revenue, some non-operating revenue. Like, let's say I'm a retail store chain, and people buy my products and services. I have revenue. But let's say I have a credit card that I private label with a bank, and I get interest income on the credit card for purchases made, non-operating. Okay, so I might actually have some non-operating, but I'm not going to, like I said, confuse you in terms of that for the midterm. Everything will be operating, that's revenue. All right, operating costs. There's a hint. Depreciation. Now here's another hint. Where did depreciation come from on the balance sheet? Net PP&E or PP&E. So if it's operating on the balance sheet, the driver on the income statement will also be operating. So depreciation of the PP&E should also be operating. Right? Operating profit is the sum of those three, or netting out those expenses. Now, this is a shortcut that I'll allow you to take, which is generally everything above operating profit is operating. So rather than just making a mistake on the math of summing them together, I can actually just start with operating profit as my ones, the sum of those. It's one of the few shortcuts I'll let you take, right, just to make your lives a little bit easier. Right? So I'm going to call that a 1, even though it's the sum of the ones above, because it's really the sum of the ones above. It's the revenue minus operating costs minus depreciation is the operating profit. So I'm just going to start with the operating profit. Also known as, at least on the midterm, you'll see this as EBIT, earnings before interest and tax. Right? By the way, this would be your EBITDA, revenue minus operating costs. It's the cash profit of the business. Right? Not that you need to do that, but I'm just letting you know if you were to see an EBITDA, that's where EBITDA would show up. Right? So, back to this statement. Interest expense. 1, 2, 3, or 4 on the labels. Three, because it comes from the debt. It's what we're paying back to the debt holders. Non-operating income. 2, where does the non-operating income come from on the balance sheet? It comes from the equity investments. The equity investments, which are non-operating, gives us the non-operating income on the equity investments. Earnings before tax is a sum, so I really don't do sums because I've already accounted for the individual pieces. The one exception to that is the operating profit, just to make your lives easier. Taxes. All right, taxes are operating. Taxes are non-operating. Taxes are a debt cash flow. So taxes are the tricky part, because what we're going to do is we're going to split up the tax impact into each one of the areas. Again, something that many of your other classes don't teach you how to do, we're going to do differently here. So we're going to look at the tax impact of each area. So 1, 2, and 3. Right? So we got the same amount of taxes when we're done. Right? Now, net income. 1, 2, 3, or 4. Who gets the net income? Theoretically. It's shareholders. So 1, 2, 3, or 4. 4. Okay. All right, so now I want to arrange my TII. So I'm going to create a new tab. I'm going to call it TII. Just so it's easy to copy and paste, I'm going to copy and paste the years. So even though this is the current year, I'm leaving in that space just so I can quickly copy and paste from the previous tab. All right, so my first item is I need to calculate my NOPLAT. So my NOPLAT is my operating income after tax, or operating profit after tax. So as I said, shortcut, I'll start with my operating profit, or EBIT. And here's where it gets a little different. If all I reported was 580, sorry, it should be 280, yeah. Oh, yeah, let me get rid of that EBIT thing because we don't really need it. So technically it should be 280, you're right, thank you for that. So if I have 280 and report $280 million worth of operating profit, and I don't report anything else to the IRS. That's all I tell the IRS. I made $280 million of operating profit, and my company pays a 25% tax rate, then what I'm going to do is I'm going to have to pay tax on the operating profit of 280 times 25%. So my NOPLAT, aka NOPAT, also known as, is the 280 minus the 70. All right, so it's the profit I would pay after the taxes on that profit. Note, the 70 is not the taxes I paid. I paid 66 in taxes as a company. But I'm saying I'd pay 70 on taxes if I just reported 280 in operating profit. Does everybody see that? All right. Now, that's my only one. Do I have any twos on my income statement? And the answer is yes. I have non-operating income of $4 million. Now, they don't write this out in the book because the guy that wrote this in the book is so familiar with these statements that they do this intuitively. But what I'm about to do might help you as you create your statements. So it's perfectly acceptable to what I'm about to do. So if I report $4 million of profit to the IRS at a 25% tax rate, I'm going to have to pay taxes on the non-operating profit equals 4 million times 0.25. So my after-tax non-operating profit is $3 million. That's the number right here. Because they netted it out. Because they knew that you were going to pay $1 million in taxes. So what they did is they took the operating profit and multiplied it by 0.75, because it's very intuitive to them to do that, 1 minus the tax rate. But what I'm saying is it might be more helpful, and you could do it that way, is to understand what's actually mechanically happening here. And what I'm saying is we report a pre-tax profit for operations, we pay taxes on it. We report a pre-tax profit for non-operating items, we pay taxes on it. Then we get our after-tax operating profit, our NOPLAT, our after-tax non-operating profit, the $3 million. Total income available to investors, TII, is the after-tax NOPLAT plus the after-tax non-operating profit, 213. Questions? Yeah.
What happens when there's like varying tax rates? So, like sometimes you have a capital gain.
So what you're going to do is you have to figure out what the tax rate that company is paying that year, and then you use an average tax rate for that year for each one of those items. But if that tax rate changes year by year, which it will in the real world, then each year you'd have to use a different tax rate. But for all 4 of the sections, you would still apply that same tax rate. So that's a good point. Other questions? All right. Next, debt cash flows. What is our debt cash flow? Well, if I go back to my 3s on my income statement, it's my interest expense. Now, this is just convention to the statement, right? The negative 20, we're going to have to flip the sign to be positive 20. And what I mean by convention is these are not accounting statements, which will confuse you because you're used to probably thinking about accounting. Here's what's different about this non-cash flow statement, this economic statement, is that if I generate profit, then I want to match on the financing side the cash flow that I earn to the cash flow that I pay out. Translation, on the financing side or the funds flow side, or we'll sometimes call that in the book, the financing flow side, payouts are positive numbers. And it's related to the idea that if I have income. So if I have profit, I can pay it out. So positive profit equals positive payout on the financing flow side. If I have a loss, I need to borrow money to fund the loss. Negative loss equals negative funds flow. I need to finance the loss, right? So it's just the convention of the way this statement is set up. So this statement is set up to generate total income available to investors. So here's the point. If I had negative 20 of interest expense and positive 20 of income, they wouldn't balance. Statement wouldn't balance. All right, so we're not doing an absolute value statement here. We're doing an actual balancing statement. So in order to have the balance, I have to have either negative 20 on both sides or positive 20 on both sides. Since I have positive income, the convention of the statement is a payout is a positive number, not a negative number. All right, same thing. If I generate $1 of profit and I give you $1 of profit, I have $1 of profit, I have $1 of payout, 1 and 1. They have to balance, they have to match. So again, you just have to get used to this format of the statement. Payouts are positive in the format of this statement because of the way the statement is created. So even though it's a negative 20 on that particular income statement, I got to recognize the payout's a positive number and I got to flip the sign. All right? So, same thing. I have interest expense, but the IRS allows me to deduct the interest expense as a cost of doing business. This creates a tax shield. Can't spell today. The tax shield is the interest expense times the tax rate. So by reporting 20 in interest, I get to save 5 because I could write off all 20 as a cost of doing business at a 25% tax rate. Therefore, my after-tax interest expense is 15. Questions about what I just did there? Next, equals. Any fours? Net income. That's my only 4. Net income is already after tax, so I don't re-tax it. There's no double taxation here. So, what are my 3s? The after-tax interest expense. What are my 4s? The net income. $213 matches $213. So what does McKinsey do? Hide. 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 That's the statement they showed you. Because like I said, intuitively to them, they know that you're going to make every item after tax, so they don't show you the mechanics. They just multiply straight by 1 minus the tax rate. And eventually, when you get familiar with these statements, it's perfectly acceptable to do that as long as you get the right note plat. I don't really care how you got it. But it might be helpful for you as you're creating these statements initially to write it out, to show mechanically what is happening, right? To show what's after tax and what's pre-tax. And again, as a rule of thumb, on an income statement, everything listed where it comes down here to everything before earnings before tax and above is usually a pre-tax item on the income statement. So everything after the taxes are paid, it would be an after-tax item, right? That's usually the rules the accountants are followed as well. So everything pre-tax is going to be tax affected. You got to tax affect it. Now, in this company, how many taxes did they pay? 66. Let's see if we still match the 66 in our rearranged statement. What's our tax and operating profits? How much tax do we pay on non-operating profits? What's 70 plus 1? 71. Right? How much do we save as an interest tax shield? What's 71 minus 5? we still pay the same amount of taxes. So we still pay the same amount of taxes. You might say, gee, why did we do this? Well, what we're doing is we're looking at the tax effect on each area of Modigliani-Miller. We're saying the after-tax income from operations is 210. We're saying that the after-tax profit on non-operating income is 3. We're saying that the after-tax debt shield, the after-tax cost of debt, is 15. So we're putting the tax impact into its appropriate area, as opposed to having one tax number that is blending multiple areas of the statements. It's mixing in the traditional income statement, the operating, the non-operating, performance, etc. So that would be the point, is that if I mixed it all together, then, and I applied that mix to the operating number, I have an operating number which is mixed in with paying taxes for non-operating items. And I'm telling you, people do this in the real world as part of their practice because they keep it simple. And we're doing it a little bit more nuanced. So I'm not saying they're wrong, they're just taking shortcuts. So I don't want you to go to another professor where he's teaching you to do valuation differently and say you're wrong, right? It's bad for your career, it's bad for your grade. Professors get angry when you challenge them, right? But what I want you to understand is they're doing it differently, right? And we're just doing it differently in this class where we're putting it with each one of the areas because we're mapping it to Modigliani-Miller. Now, again, we will eventually take some shortcuts later in the semester, but that's the point. If you take a shortcut, I want you to understand that you're taking a shortcut and why you're taking the shortcut that you're taking. All right, so I'm going to also make you do it more formally. There's another reason to do it more formally, which is you're more likely to get a correct answer. If you have to balance the statement and show both sides, if the numbers balance, you probably got it right. If you do one side of the statement and you don't do the other side of the statement, you hope you got it right, but you don't really know. You don't know with 100% certainty. So one of the advantages of balancing the statement is you're pretty certain you got the right answer. Now technically you could balance a statement and still have a wrong answer if you put the wrong items in the wrong place. That's why the labeling is important. I don't want to mix my ones and twos because I can add my ones and twos together and still get the enterprise value, but I can still mix up my ones and twos and get the wrong return on my investment. So again, that's why we're going to balance, that's why we're going to put the statements in labeled order, because that's going to tell us we have a truer representation of the financials. All right. Questions about that? Statement number 3, CFI. This is the one you're going to struggle with. I'll just let you know you're going to struggle with it. First 2 you'll probably do pretty easily in your homework and in the midterm. This is the one you'll spend a lot of time. And it's just because it's different. Now, here's a misnomer. The way the book had set it up on the previous statements, the statement on the left, the accounting statement, became the statement on the right, rearranged. That is not true of the statement of cash flow. I want to be really clear about this. The GAAP statement of cash flow on the left does not get rearranged to the statement of CFI on the right. You cannot get to the statement of CFI from the GAAP cash flow statement. You just can't. You have to do it from the income statements and the balance sheets. So you might ask, why did they put the GAAP cash flow statement on this slide? And the answer is there are pieces of data on the cash flow statement that aren't on the income statement that we will need in order to do CFI. One is depreciation. Often depreciation is buried in cost of goods sold on a traditional income statement. And we need to know depreciation to get cash flow. So typically, I'm making it simple on your exam where I'll tell you the depreciation, but sometimes you'll actually have to figure out the depreciation separately because it's not given to you on an income statement. All right, so that's why you'll need a GAAP cash flow statement. The other reason you'll need the GAAP cash flow statement is the dividends. Dividends don't show up on income statements. Income statement ends with net income, right? So therefore, we need to know the cash dividends paid to get a cash flow. So again, we're going to find the cash dividends paid on the GAAP cash flow statement. So again, the point of the GAAP cash flow statement is to give us dividends and to give us depreciation if it's not broken out on the income statement, which a lot of companies don't. So that's why we need that GAAP cash flow statement. Now, statement on the right, CFI. So here's the key. I'm going to create a third tab in here. I'm going to call it CFI. And I'm going to copy over the same years. So I can copy and paste across my tabs. Now, here's what's going to be important about CFI. As I mentioned before, cash flow is cash coming from the income statement minus cash reinvested in the balance sheet. So income statement minus change in balance sheet equals cash flow. Right? So we're going to go through that process 4 times. First, we're going to do it with the operating items. What is my operating cash flow from the income statement? Which I'll get out the statement of TII. What is that? What's the operating item on here on my TII? Yeah. It's my NOPLAT or NOPAT because I do it after tax. That's the cash coming from the income statement. What's my balance sheet? Invested capital, right? Oh, sorry. To get to cash flow, take it back. Rewind. Cash flow is what's called gross cash flow. So to get to free cash flow, operating cash flow is gross cash flow. It's NOPLAT plus depreciation. Because I have to add back my depreciation to get to the operating cash flow from the income statement. So I then had to take my depreciation, which fortunately was listed here, and I have to add back my depreciation. So in this case, since I'm going to add it, I'm going to flip the sign. So that's going to get me my gross cash flow equals NOPLAT plus depreciation. So free cash flow is gross cash flow, cash from the income statement, minus what's called gross investment. So what is gross investment? Gross investment equals, from my TFI, current year invested capital minus previous year's invested capital. That's how much new invested capital, plus depreciation. So change in invested capital plus depreciation equals gross investment. What is free cash flow? Equals gross cash flow minus gross investment. That's the operating free cash flow of the firm. Yes?
Maybe how you get gross investment.
So change in invested capital. So current year invested capital minus previous year invested capital plus current year's depreciation equals gross investment. Calculating it this way is acceptable on your midterm, is acceptable on your homework assignment. Now, I'm going to show you the granular way, call it alternative 2, for calculating gross investment. So I'm going to add some space here. It's change in invested capital. So it would be my change in working capital equals, from TFI, current year working capital minus previous year working capital. 0. Working capital went from 75 to 75, so therefore there was no change. Think about it this way. Inventory went from 200 to 225. I tied up 25 in cash and inventory. Accounts payable went from 125 to 150. I didn't pay my vendors 25. So they have no impact on cash in my change in working capital. Right? Next, change in, and this, the key word here is net PP&E, is based on capital expenditures. So, capital expenditures we'll call this CapEx. So capital expenditures also known as CapEx, equals, think about it this way. If I take my beginning PP&E plus my CapEx minus my depreciation, I get my ending PP&E. That's just the balance sheet. So my starting PP&E plus the capital expenditures I spend the year minus any depreciation I have during the year would be my ending PP&E balance, assuming I didn't take anything out that's fully depreciated. Everybody got that? Remember that from accounting? So here's what we're going to do for CapEx. We're going to solve for CapEx. So CapEx equals basically end PP&E minus beginning PP&E plus depreciation. That's just rearranging that equation to solve for CapEx. And you might say, why am I solving for CapEx? Because I can go to the accounting statement and get the capital expenditures, right? And here's the reason. Because the accountants have gotten, in my opinion, sloppy in accounting over the last decade or so. And what they're doing now is that they're making direct changes to the balance sheet that never hit the income statement through something called AOCI adjustments, right? Adjusted other comprehensive income. And unfortunately, when they go in and make these direct adjustments to the balance sheet and they don't show you the impact on the income statement, it really screws up your statements, because that's the point. The income statement explains the changes in the balance sheet. And the income statement has any differences between the change in the balance sheet, it makes our lives difficult. And the accountants would say, well, just go to statement number 4, which is the change in, was it change in retained earnings, equity, change in net income? I don't even know. This other weird statement that nobody ever looks at. The accountant's like, go figure it out in that statement what adjustments we made. Because what they'll do is they'll just write off assets. And they'll just write off the assets in the balance sheet, and they'll just directly debit the balance sheet and credit the balance sheet, and they won't hit the income statement. So basically, it will screw up the CapEx, and what'll happen is you won't have a balancing statement, so you'll have to figure out what the other adjustments that they made are, and you have to back into the other adjustments. Well, that makes my life too difficult. So here's what I'm going to tell you, is that because they're making adjustments that affect CapEx through AOCI adjustments, what we're going to do is we're going to solve for the CapEx. We're not going to use the CapEx that the accountants tell us, because they made some other adjustments elsewhere. We're going to say that the balance sheet, in order to balance, we can solve for the CapEx, because we knew the starting PP&E, we knew the ending PP&E, we knew the depreciation, so that had to be the CapEx. Now, 80% of the time, it'll match the CapEx accounting reports, but 20% of the time, it won't. And this will save you on the 20% of the time it doesn't. So we're going to solve for the CapEx. So, how do we solve for CapEx? Equals, back here, ending PP&E, TFI, minus beginning PP&E, plus current year's depreciation, 70. 70, 70. That's my gross investment. Why is gross investment change in invested capital plus depreciation? Because capital expenditures is the plus depreciation. It's just carrying it through on the formula. It's the change in working capital, the change in net PP&E plus depreciation. That's where the plus depreciation comes from, when you add those two numbers together. So that's what I said. Shortcut, granular. Get the same answer. Questions? Operating cash flow. That's called free cash flow. Gross cash flow minus gross investment equals free cash flow. Non-operating cash flows. Off the income statement. TII. What do we have? After-tax non-operating profit. It's consistent with my labeling here. That's the cash profit after tax that we make for the income statement. Balance sheet. Change in equity investments. Equity investments went from 15 to 25, they went up by 10. That will then get us CFI, which is cash flow available to investors. Now, you just have to start applying common sense when you're doing all these changes. Cash flow available to investors is the amount of cash that we can pay out to our investors. So, if we have free cash flow of 160, does that add to our CFI or subtract from our CFI? Should add to our CFI. Free cash flow adds to the cash that we can pay out. If we take $3 million of after-tax non-operating profit, does that add to what we can pay out to our investors, or does that take away from what we can pay out to our investors? It adds. If we spend $10 million on new equity investments, does that add to the CFI or take away from the CFI? If we buy more stakes in other companies, it reduces the cash that we can pay out. So we increase our equity investments, we reduce the cash we can pay out. I have to subtract that number, the net of that number. So I can either subtract it or switch the sign if I want to add them together, but basically I'll sum these three together, and that is my cash flow available to my investors, 153. That's the same 153 that's right there. Again, I don't know how to give you rules other than to say you have to kind of look at the statements and think about what's happening here. Am I generating cash profit? It adds to my CFI. Am I spending cash? It subtracts from my CFI. That's the rules for adding or subtracting, right? I just have to think about it as I'm structuring the statement. Now, typically, because the statements always come in a similar format, once I've set it up, I can reuse it for all my other statements, but nonetheless, I have to set it up that first time. Now, that's going to match the financing flows. I have 153 to pay out, just like on TII. I should have 153 of cash that's going out to my investors. So, debt equals, from TII, my after-tax interest expense. Again, payouts are positive numbers on this statement as well, because I'm matching the cash flow available to investors. I have cash flow, I can pay out the cash flow. So that 153 positive becomes 153 positive. A debt payout to investors, interest expense, is a positive number on this side of the statement, just the convention of the statement. Then I have my change in my debt. My debt went from 200 or 225 to 200. I paid off 25 of debt. Positive or negative number? Should be a positive number, so I'd have to flip the signs. Payouts are positive. I paid out. Where'd it go? Change in equity. Equals common stock minus common stock. Again, what if I had issued common stock? This would be a negative number, so I would have had to flip the sign. But I didn't. I just showed you that as an illustration. Put this back at 50, so the change is 0. Right? Net income. This is one of the two tricks to this statement. Trick number 1, net income is not a cash flow. Therefore, the cash flow to the equity holders, which is our 4th section, is the dividends. So what I actually need is the dividends, not the net income. That's why I need the statement of cash flow, and the dividends were 113. So my dividends were 113. It's a positive number. this was change in common stock. So technically I would have done my dividends first. Income statement, then balance sheet. All right, so dividends, change in common stock. Dividends are a positive number because it's a payout. Then I have my change in retained earnings equals retained earnings went up by 85. That's new equity in the firm. Positive number, negative number. If I have more equity, positive or negative? Be a negative. So I'm not paying it out. So then I sum these together and I get my CFI balance. Or at least it should balance. I made a mistake. What mistake did I make on my cash flow available to investor statement? It's my change in retained earnings. Why is that a mistake? Because a change in retained earnings is not a cash flow. Retained earnings is not a cash item. A change in a non-cash item is not a cash flow. So that is number 2. I said there were 2 tricks. The first trick we talked about. This is the second trick. The first trick is dividends, not net income, because net income is not a cash flow to the shareholders. Dividends are. The second trick, a change in retained earnings is a change in a non-cash item. Change in non-cash items don't affect cash flow. If I take out this change in retained earnings, voila, my statement's balanced. This statement you'll struggle with for these reasons. There's 3 tricks that you're going to have to struggle with a CFI. 1, keeping the sign straight. And that's just getting used to the convention of the statement. 2, dividends, not net income. 3, change in retained earnings is not part of CFI because it's a change in a non-cash item. If you can keep those 3 straight, you'll do okay on the statement. And again, it doesn't hurt to keep the labeling. And remember, each section is cash flow from the income statement minus cash invested, change therefore in the balance sheet. Questions? I'm going to save this spreadsheet and I'm going to put it on Elm's Canvas so that you'll have what I did with all the formulas. All right? We've been recording this class. I'm going to also post the video of the class on YouTube. All right? So here's the thing. I have 2 TAs for my undergraduate section. They both got really good grades in a version of this class that I teach to undergrads last semester-long class. And they know how to do this. So they're not technically your TAs. However, they're not going to grade any of your assignments. But as you're struggling with this, you're welcome to talk to them in their office hours. Okay? So I just want to let you know, their office hours, I'm going to post this on Canvas. But basically, the 2 TAs are, and they're undergrads, but like I said, they know how to do this stuff. They are Mandy Zhu, and her office hours are Wednesday between 1 and 3. And the other is Mike Elef, and his office hours are Thursday between 5 and 7. Okay? And I'm going to post this onto Canvas, but they share my office, which is 4468 in this building. So in the finance department, 4th floor, if you go into the finance department, take a left, I'm the last office all the way at the end of the hall, 4468. All right? I'm not going to be there for office hours, but they will be here the rest of the week. So the reason I ask is because you're going to have a homework assignment. It's due on Monday, not Wednesday. right? I'm going to post it probably in the next 30 to 40 minutes on Canvas. So your homework assignment is to convert the statements, and they will be more complicated statements with new categories that weren't talked about in our in-class example, right? I'm going to also give you a practice conversion with a practice solution, right? So you're going to get a practice conversion with a practice solution that you can use. I'd strongly recommend try the practice conversion with the practice solution, but then you're going to have a graded homework assignment without a solution, and you're going to have to turn that in, individual assignment, right? Now, here's the nice thing for you. I'm going to give you the labels, the 1, 2, 3, 4s. So you won't have to label everything 1, 2, 3, 4. It will be pre-labeled in a spreadsheet. So you have to basically do the same thing we just did in class. Convert the statements. The 1, the 2, the 3s, the 4s, convert it into these statements, right? And then we will go over this in class on Monday, right? By the way, we'll do another example on Monday, and we'll practice on Monday and Wednesday so that your exam, which is a week and a half from now, that's your exam. Most of your exam is going to be, here's the statements, convert them. So lots of practice in the next week and a half before the exam, which is 2 weeks from this past Monday. Comes quick in this kind of compressed class. All right, so questions about any of that? So I'm going to post this to YouTube. I'll put the link in the pages section of Canvas. That's where the YouTube links will be all semester. I'm going to post the names and office hours and email addresses of the TAs. You can also reach out to them for help as you're working on the assignment. I'm going to post the assignment, which will be due on Monday, beginning of class, that's turn in through Canvas, which is the conversion of the statements. All right? If you have any questions, you're welcome to email me. Otherwise, have a great weekend. See everybody on Monday.